Good evening, all of you. On behalf of Professional Development Committee of the Western India Regional Council, the Institute of Cost Accountants of India, I welcome all of you for the today's session on UPSC ICoAS preparation for newly qualified cost accountants. Our today's speaker is CMA Rashmi Mudgal ma'am. She is a practicing cost accountant. Now I request ma'am to kindly start the session, ma'am. Thank you.
Thank you so much. Today we are going to look into the transfer pricing. We have covered the costing techniques, costing method in the previous sessions, and now we are actually looking forward to the transfer pricing. So in the transfer pricing, it is a relatively new concept. How it comes into the knowledge and how it comes into the system by two method. One, it is actually relative to two streams. One is the costing and one is the income tax act. So in the costing we are going to cover, and in the taxation it is into section 92A, 92B, 92C. So 92A is relative to associate company and 92B is arm length price and 92C is the international transactions. So we are going to take transfer pricing today and the method of transfer pricing as well as why the transfer pricing is important and which method is actually needed to be taken care in this, where I am going to take you to the transfer pricing methods, techniques, as well as firstly we need to understand that transfer pricing is not a exclusive definition. We can take any method whatever we wanted and whatever the industry is taking care. But yeah, there are some theories which we need to take care while we are calculating the transfer price. So I am taking you to the PPT first. Can everyone see the PPT? Is PPT is available?
Yes, ma'am.
Okay.
Okay.
Now we are going for the transfer pricing, and actually we are covering the costing part today because we are going to cover the costing sessions in this webinar. So we are not touching the tax part, but we are taking care of the transfer pricing methods in this webinar. So this firstly consists of the meaning of transfer pricing. What exactly the transfer pricing is, why the transfer pricing needed actually. So transfer pricing can be defined as the value which is attached to the goods and services transferred between related party. So here the important word is a related party. Whenever we are transferring any goods or service to a related party, we are going to calculate the transfer pricing. Why we are calculating the transfer pricing? Firstly, we wanted to be true to our accounts. We wanted to know that are we going to make profit or not first. Second thing, regulation of the government also there are so many points which we are going to cover in this webinar, which will make you feel that transfer pricing is important or why transfer pricing need to be implemented in every organization, even though we are not doing any international transaction as well. So for example, a manufacturer and distributor owned by the same parent company, the effective management of transfer pricing allow global companies to avoid paying unnecessary taxes and achieve the best financial outcome. So what happens here in this example, the manufacturer as well as distributor owned by the same parent company, like Hindustan Unilever as well as Unilever and some Sri Lanka Unilever is there. If they are somewhere doing transaction between each other, then they need to know what profit Sri Lanka unit is making, what profit Hindustan Unilever is making. So the effective management of transfer pricing allow global companies to avoid paying unnecessary tax, so that they will pay a tax which is necessary, which is lawful, which is legitimate, not the they can't take unnecessary advantage also, and they don't want to end up paying unnecessary tax. And they wanted to get a good command over the truthfulness of the data also. In the world of corporate tax and accounting, transfer pricing is the practice of setting the price of goods and services for transaction between affiliated organization. So here what happens, in other words, we can say that transfer pricing is the price that is paid for goods or services transferred from one unit of organization to another unit situated in the different countries. There are some exceptions, but yeah, different countries are more used for the transfer pricing. But it is not limited to here. It is also somewhere going passing to the normal units of the business also, which are in one nation or in one country. What is the purpose of transfer pricing? The key objective behind having transfer pricing is, firstly, is generating separate profit for each the division and enabling performance evaluation to each division separately, where I wanted every division should know how to make a profit, how to work efficiently, so that they can make a profit, and what is the outcome of every division. And second is transfer pricing would affect not only just the report profit of every center, but would also affect the allocation of company resources, where I wanted to put more resources, where I wanted to do I am making less profit in this scenario. I even can make a outsource it and do this is a dead end where I am making it and its cost is more than the price available in the market. So I can of allocation of resources also. Cost incurred in one center will be considered as a resource utilized by them. So if I am spending so much amount here, what cost of production is there, that will be considered as my resource utilized. Okay, so next we come to transaction subject to transfer pricing, where the transfer pricing actually comes when we actually need to think about the transfer pricing should be implemented here or not. There are some cases, it is not limited to this list, but yeah, I have put some list into here where you can understand what kind of transaction invites the transaction pricing. Okay, sale of finished goods, when I am selling the finished goods to from one department to second department, that place is actually open for the transfer pricing. Purchase of raw material, when I am actually purchasing my raw material from another department, that will also be considered. Also, not from only department, but from a company which is subsidiary to my my holding company or my parent company, where I am associated with them. Okay, purchase of fixed asset. There may be a possibility that I am purchasing a fixed asset from the department or maybe from another company which is associated with me in any manner. Maybe the holding, maybe the subsidiary, maybe the associate company, or maybe we are doing any joint venture together. So it will be purchase of any fixed asset from this that companies will definitely gonna attract transfer pricing. Sale of purchase of machinery, sale or purchase of any machinery. If I am selling and purchasing any machinery, then also transfer pricing will come. Sale and purchase of intangible, when I am using trademark registration, using know-how rights, I'm using the research and development, where I am using intangible assets in form of sale or purchase from the associate or from the transfer pricing as well to make a profit. Reimbursement received. For example, if I have spent something on behalf of my associate company, or maybe a parent company in Australia is making some payments on behalf of companies in India, so they will reimburse that expenses. They will ask for the reimbursement. So if I am doing the reimbursement, I have to think about the transfer pricing. I cannot reimburse every amount whichever will be charged to me. I see is this related to me or not. And if it is for the whole group, do I need to pay whole amount or maybe as per the ratio like I mentioned? So this is also area where transfer pricing comes into the picture. Okay. IT embedded services. IT embedded services, enabled services softwares like SAP, everything has been taken care by the parent company. So parent company once spend everything over technology and IT, but after they do their subsidiaries to their subsidiaries. So when they distribute the subsidiaries and dividing the cost, I need to think about the transfer pricing at that place also. Support services. Support services can be customer care. We can see many companies has their customer care in India, but they are not operating in India. So what they do, they actually allocate that cost to the country where the sales are done. So if the sales are done in another country and expenses done in India, so obviously they wanted to take this expense to the company which is related to this expense. So that time also transfer pricing will come into the picture. Software development services. Again, a company's parent company do all the research and software development, or maybe another company on behalf of all the group of the companies. So here also in software development, they will definitely gonna, maybe they will got a reimbursement of the expense, or maybe they will get a credit for that expense. They have to think about the transfer pricing in this area also. Technical services fees. So again, technical services fees, whenever they need technical support, there is a management fees also, where management fees has been distributed among all the departments in all the subsidiary companies. Royalty fees, if I am paying a royalty on behalf of my some company, that will also attract the transfer pricing. Corporate guarantee fees, where I am paying corporate guarantee on behalf of all the companies, then also transfer pricing will come. Loan received or paid. If I am paying loan on behalf of someone, or someone is guaranteeing my loan uh, to the bank, then also transfer pricing comes, because there is a cost incurred with this. And if I am taking loan from my associate company at a somewhere at a discounted rate, that also comes into the picture of transfer pricing. Okay, so now we are going to why it is important. We have taken care of this, that what is a actually transaction, but why it is important, why we do need to read this concept, why we do need to implement this concept. So for the purpose of management accounting and reporting, multinational companies have some amount of discretion while defining how to distribute their profit and expense to the subsidiary located in various countries. So they wanted to distribute their expenses as a parent company. They do many expenses on behalf of their small subsidiary companies, and then at the end they wanted to distribute as per their ratio, maybe the sales ratio, maybe the expense ratio, maybe the consumable ratio. There could be possibility that they will definitely gonna want to know that what is my subsidiaries making as a profit. It is important that a business having cross-border intercompany transaction should understand the transfer pricing concept, particularly for the compliance purposes. requirement as per law and eliminate the risk of non-compliance. So there is a compliance liability is also there, where you need to comply with the transfer pricing, where you want, where you need to show your expenses, which is inter-border, and you are going to make profit out of another cost which is not available in India. So they definitely want it into a certain manner where they wanted to know what is the profit and they wanted to charge the taxes over it. The companies were before the transfer pricing, company used to do more expensive things so that their profit can be declined and they end up by paying less taxes. So after transfer pricing came into the picture, the companies are going to pay legitimate taxes, even though they are providing the expense as per the cost. So profitability of subsidiary depends on the prices at which intercompany transaction occur. This these days intercompany transaction are facing increased scrutiny by the government. Here, when transfer pricing is applied, it could impact the shareholders' wealth, companies' taxable. So if you see here that what company is making profit as an individual, then so if a company wants to pay less tax, they can definitely some parent company or from their subsidiary company. So to remove this, the company transfer Sorry, there is an internet dropout. Am I audible now?
Yes, ma'am.
Okay. Okay. So sometimes a subsidiary of a company might be divided into segment or might be accounted for as a standalone business. In this cases, transfer pricing help in allocating revenue. It is really important that transfer pricing concept, particularly for the compliance requirement as per law and to eliminate the risk. So here, company, if they wanted to do the cross-border businesses, they have to respect the country's law and they have to look after the transfer pricing as well. So the knock-on effects are effects which are very silent. They are actually a effect which comes with the transfer pricing. they are positive effect. All these are positive effect if we are using it in a right way. There are 6 knock-on effect, which is performance evaluation, performance related pay, make, abandon or buy in decision, motivation, investment appraisal, taxation and profit remittance. So now we are going to discuss them one by one. A performance evaluation is basically actually depends upon the transfer pricing. How this is depend upon the transfer pricing, where we can actually judge the division's performance, or if we can see that is the department is doing good or not. Are they meeting the parameters or benchmark or not? The success return on investment or residual income will be changed at head office to close it down. So we can see here that if performance is not going better, benchmark also, or maybe it is not meeting matching change the division. Okay, next is performance related pay. If my performance is good, I'm getting good pay. So in the, if there is a system of performance related pay, remuneration of employee in each division will affect as a profit change. If they feel their remuneration is affected unfairly, a good remuneration at their performance, their motivation. If transfer pricing is very high, we can see, but we are
Hello, ma'am. Your
somewhere
voice is
ending
not
up by
clear.
the cost of production. Okay, 1 second. Shall I change the network? Hi, am I audible now?
Yes, ma'am.
Okay. Now comes to make, abandon, buy in decision. How this affect the decision, where I am actually somewhere related to the make, abandon and buy decision. Okay, so what happens if transfer price is very high? It is even higher than my market price. Then I have to think about whether I should buy it any component, or I should make it into the company, or I should abandon it, or maybe I should drop this production. Even the production will work after stopping this activity also. So in this area what decide is not to buy components from the transferring division, because it becomes impossible for to make a positive contribution because of this department only. The bottleneck is will be somewhere, bottleneck will be also recognized by this exercise. This division might decide to abandon the product line or buy in a cheaper component from the outside supplier, because my cost of production is higher than the I am getting it goods from the another company which is doing it in a cheaper price because of many factors. Motivation. Motivation, everyone likes to make a profit. And this ambitions certainly apply to division managers also. If a transfer price was such that one division found it impossible to make profit, then employees in that division would probably be the demotivated. In contrast, the other division would have an easy ride as it would make a profit easily, and it would not be motivated to the work more efficiently. So in this area, I have to think about that if I am going to make this division wise profitability and division wise transfer pricing, division wise sales and purchase, I have to see there that everyone is feel motivated and everyone thinks that there is an area of improvement where they can improve also. Investment, investment appraisal. New investment should be typically be evaluating using a method such as present value. However, cash inflow in arising from an investment are almost certainly going to affected by the transfer price. So capital investment decision can be depend on the transfer price. Do I need to make a more product from here? Do I have a open market where I can sell more product? Do I have a capacity? Do I need to increase my capacity? So if I wanted to increase my capacity, there would be a capital infusion there. So these decisions can be taken by the transfer pricing also. Taxation and profit remittance. If division are in different countries, the profit earned by each country will depend upon the transfer price, because definitely they are going to interact with each other, they are going to do some transaction between each other. So profit of every company will depend upon the transfer pricing. This could affect overall tax burden of a group and could also be amount of profit that need to be remitted to the head office. So every company will definitely gonna give some profit to the head office because they are also working for the subsidiaries and the registered office and branch offices. So they are going to share the profit with the head office, because without them they cannot work at all. Okay, characteristics of a good transfer price. How to know this is a good transfer price I am using? See, what is the technique to calculate is a second, but firstly I need to think about, is this fair? The that preserve the divisional autonomy, be perceived as being fair for the purpose of performance evaluation and investment decision, permit each to make a profit, encourage division to make a decision which maximize the group profit. So this is the areas which can be elaborated like this, like preserve divisional autonomy. How they can preserve this? Almost inevitably, divisionalization is accompanied by a degree of decentralization, where I wanted every decision making to do with the specific manager and team are put charge of each division and must run it to the best of their ability. Divisional managers are therefore likely to resent being told by head office which product they should make or sell, but ideally, divisional should be given a simple, understandable objective such as maximizing divisional profit. So if they are getting this profit maximization target, they will always gonna end up making the more profit at this. Second is be perceived as being fair for the purpose of performance evaluation and investment decision. So they wanted to be as a fair, not only as a performance evaluation, but investment decision, but also as a taxpayer, also as a profit maker. Obviously, na, if I am making a good profit, then only investment, my investor will be happy because they are getting more profit over it. Permit each division to make profit. They allow to breathe. They allow to breathe. Profit are motivating and allow divisional performance to measure using positive return on investment and positive residual income. Okay. Fourth is encourage divisions to make decision which maximize the group profit, which maximize the profit. The transfer pricing will achieve this if the decision which maximize divisional profit also happen to maximize group profit. This is known as goal congruence. Furthermore, all division must want to do the same thing. There's no point of transferring division being very keen or transferring out if the next division doesn't want to transfer in. So these were the reasons, these were the qualities of a good transfer pricing. Now we are going to discuss what are the base transfer pricing. So we know cost based transfer pricing, where we actually think what is the cost of production. We actually rely on production cost. We rely on competitor price. We rely on taxation. We rely on managerial reviews. Cost-based transfer pricing is a method of setting prices when selling product to division within the same company. Several factors affect the uh, transfer pricing of cost-based, which is production cost, competitor cost, taxation, and managers review. Depending on the type of product traded and its availability in the external market, you can set the price as a market-based, cost-based, or negotiated pricing. In this, we are going to discuss cost-based transfer pricing as well as other methods also. But how can you compare and calculate it with the other methods also? So we are going to discuss the other method also, but deeply we are going to discuss about the cost-based transfer pricing. It is to maximize profit and enhance competitors, companies, encouraging intra-company traded and purchasing between the divisions. The pricing of product from one division to other is the transfer price. Okay. So till now there is any question? Okay. Next is there are different methods to select the cost based price. So there are three methods I'm looking into. First is marginal cost. Second is full production or cost plus markup. Production cost plus markup. So here what happens, there are different methods to select the cost based transfer pricing. Marginal cost is what we have completed in the second webinar of mine, where we actually look after the marginal costing, where we produce one more unit with the production. The increase in my cost is a marginal cost. Increase in my total cost is my marginal cost. In the short term period, it is mostly the variable cost. It is mostly the variable cost. A company division record all its part to make a product and didn't add variable and It adds variable overheads such as energy bill and cost of rent of factory space and everything. Next is full production or cost plus a markup. In this method, a company adds fixed overheads expenses that stays the same despite challenges to the number of component to the cost of each item. Production plus a markup. Production plus a markup. What happens in this method? Full cost plus includes cost of items, markup, or profit allowances in region item. It on the production cost. What is my cost of production? Next, I come to the see what exactly the cost-based transfer pricing do. It is used to reduce the tax. For example, if a company owns and operate a factory in a country with a low tax rate, but sells its product in a country with a higher tax rate, it pays fewer tax by setting a high transfer price. By setting a high transfer price. This is the conclusion where we can see where cost-based pricing is normally taken care. Benefit of cost-based transfer pricing. Why it is benefited? Firstly, two major benefits of a company to use the cost-based transfer pricing that are act as a profit mobilizer where we can make or send a profit to the head office, and sometimes the another division can transfer their profit because that country is going to apply large tax amount than the Indian tax law. It is not into the real world, but yeah, in the monetary form, there can be possibility. It encourage high profitability for the company by basing pricing and production decision on how the price affects sale on CVP basis. The concept improve the return on investment, which can assist the buying division in quickly breaking even. And second is it is simple as predictable. It sets pricing at a total cost, at the total production cost, meaning that selling division cannot realize any profits, and buying division already aware of pricing based on how much it costs to make. Next is some pros of the cost-based transfer pricing include it is useful when setting up the prices for the low risk and innovative item. It is helpful to accounting officer to make appraisal decision, for instance, to use the correct return on the investment numbers. Next is by monitoring the cost of production. Cost-based pricing ensure that they recover all incurred cost. At least that cost need to be recovered. Next is some cons could include. First is the approach does not offer incentives. कोई incentive नहीं है. There is no incentive in this approach. Next is the firm loses opportunity to change a higher price in an external market. If I am going to change the price for my associate company, but I am higher charging higher prices to outsider, this will gonna make my reputation lower than what I have. Next is it does not recognize the impact of that focus forces of demand and supply. So firstly, they don't recognize the impact of a forces also. So they can't see that there is a demand or not, there is a supply or not, but they will definitely gonna see what is my cost. Am I going to make a profit or not? Am I need to make a profit over a bank, or am I need to make a profit over a friend? So this is the cost-based transfer pricing benefits. Up next is market-based transfer pricing. Market-based transfer pricing. We could start with the example here. What happened? Market-based pricing would be when a person goes to a grocery store and see different brands with different prices on them. Person might see some brands have a higher price than other brands because they have more demand for their product. So they can go with the market price where they will say we are going to pay the same price what is available in the market, and the other competitors are selling the same price, then only we will buy from you. Even though you are a division, we will think of the market option also. Market-based transfer pricing provide a simulation of the market within a company. By representing market condition, a company sells the product at the same price as it does in the market. The method requires to access standardized existing market for the product or substitute. Okay, companies can calculate a market based price by comparing the current prices of the current prices of the product in competitive market also. Companies can obtain transfer pricing from the marketplace if comparable product is available. Only in this case it can be possible. Okay, the prices of goods or services are determined by the what consumer are willing to pay. What consumer are willing to pay. Okay, this is here in this situation. Market-based pricing method is also called competitive pricing, where every consumer can make or break the price, where demand and supply plays a very good role. Okay, so which means the prices are set based on the level of competition in the particular market. In this scenario, only market runs the profitability, not the cost of production, not what profit they need to make, or not any kind of negotiation are there. So market price based transfer pricing is doing in this. Next is negotiated transfer pricing. What negotiated transfer pricing do? In the negotiated transfer pricing, company representative negotiate price on their own. So they sit on the table and decide, it is my cost of production, I'm going to sell it at this cost. If you are ready, then fine. If you are not ready, I'm going to sell it in the open market. So in the negotiation, there is a hard ball playing. Instead of relying on the market price, instead of relying on the cost of production, they go with the negotiation. Sometimes the transfer price between the subsidiaries is required to be determined with no reference to market pricing. The situation occurs when there is no obvious market price because the market is small or has a highly tailored item. For example, my product is available in the market, but I need to be these things need to be tailored for my use. So I will definitely gonna go with my own option where I am giving work to my own subsidiary or my own associate. So I am going to buy from them. But yes, negotiation will be there as a part of business. Okay, so negotiated transfer price cannot always fulfill the primary function of the transfer price, such as profit allocation and coordination. So this is more of a tuning of the people who are sitting on the table and what they wanted from each other. So negotiation is totally a human based, how the human behavior react to each other. What is the difference between the cost based and market based? Firstly, cost based transfer pricing is useful when external market information is unavailable. where I don't have any information around the outside my own division. I believe that my product is always cheaper because I'm making it. However, market-based transfer pricing is more practical to use when there is a competitive external market for your product. There are so many companies who actually outsource some products for themselves because they don't want to produce it. If they will produce it, their cost of production will be higher. So if there is a market-based transfer pricing, always better in any situation because they are getting a competitive price and they can decide do they need to make it or not. This will also be there. Okay, divisional performance. Divisional performance is more likely to represent the real contribution of the division to prof- company profit. When it records transfer goods at a market price, if a division of a good company can't buy a product from another division, it will have to buy it at the current market price from outside. So both the difference is there ki we can't get a good from the market, so we have to go with the cost plus method. And there is a issue where I am able to get the product from the market at a lower cost. I'm definitely gonna get from there. Okay, it will have to buy it from the current market price from outside. Divisional profit would then be like the calculated profit if the division were from separate companies. So if the companies are different, they are different to each other, then we can go with the market-based transfer pricing. What is the cost-based versus negotiable transfer pricing? As compared to both cost-based and market-based transfer pricing. Negotiated transfer pricing is a middle ground where the selling and the buying division, supervised by the top management, agree on the best price for both. Where we actually wanted a win-win situation, that I wanted a less price than market, as well as I don't want to produce it by myself, I want it from you only. I don't want to go anywhere else also. So make a price where it is lower than the market price and upper than the cost of production. So it will be a win-win situation for both the division. The two negotiate a arm's length price and decide to sell or buy from the external market or trade within themselves. Unlike the cost-based transfer and negotiated transfer approach minimize the conflict between divisions. They actually somewhere make a way where they both win into this negotiation or in this transaction. And like market-based transfer pricing, it encouraged division profit to maximization, where we wanted to make the profit also by the division. Types of transfer pricing method. Now I'm going to talk about transfer pricing method. They are not exhaust list. There is a big list which we can go with, but there are normally we do take these three methods. First is first is normally known as cup method, that is comparable uncontrollable price method. Second is resale price method, and third is cost plus method. Okay, so in companies use the transaction method to compare the condition and price of the product and services in controlled transaction with those in an uncontrollable transaction with the unrelated party. So here what I do the comparison of what I am doing with my subsidiary or related party and what I am doing with the unrelated party. If I am selling unrelated party at the amount of 10 rupees per unit, and if I am selling the same quantity to related party at a 9 rupees, then I have to think about the transfer pricing method I am using. It is wrong because of In the non-related party, I'm using it at 10 rupees. So I have to take a 10 rupees because it is comparable uncontrolled price. That is comparable uncontrolled price. Next is resale price method. This technique factor in the selling price of a product or service, also known as resale price. A reselling price is prices that allow companies to sell an item to independent business again. Okay, so they actually give you where you are reselling the price. Okay, so techniques, what they do, if you are selling, if you are selling it to someone else, then if you are selling to an independent business again, so what is your reselling minus my, tell me the reselling price and pay me that price only. So we will consider as a transfer price that reselling price. Cost plus method, again, this actually goes with where we actually calculate the cost of sales. We take all the cost. If I am saying about the cost of sales, I am considering the my fixed cost as well as variable cost. By calculating the cost incurred by the supplier in the affiliated transaction, companies figures the overall cost of the transaction. So we are going to discuss the cup method again. Firstly, the cup method is a traditional transaction method. It looks at the term and condition of transaction made between two both related and unrelated organization to ensure the arm length pricing across the board. In most part of the world, it is called as cup method, but in US, it may be referred to as any of the following. The cup method for pricing tangible, the comparable uncontrollable transaction method, cut method for pricing intangible goods, or the comparable uncontrollable service price CUSP method for pricing services. We'll later refer to the cup method as an article I am looking into. The comparable uncontrollable price method is the one for mail transfer pricing method. It is used to ensure the transaction between related companies are comparable in the price of those conducted with the unrelated organization. So key points we need to think before going for the cup method. Firstly, methodology. Methodology, what they do, they actually traditional transaction method that assess the terms and condition of the transaction between the both related and unrelated organization to establish a arm's length price. So they actually look after the related and unrelated party where they can think of is is fair to transfer at this price to the related person or not. Naming variation. Internationally known as cup method, it is United Statement cut and cusp method is known. Application. Application cup method can be applied in two ways, internal cup or external cup. Internal cup is like if my all the companies are selling in the same prices. An external cup is for the market comparable uncontrollable price. Okay, so internal cup is what involves finding example of comparable transactions a company has conducted with the third party. Transaction pricing regulation requires that the term of related transaction match those third party transactions. And what is external cup method? External cup involves looking at the pricing of a comparable transaction between third parties to extent that such comparable transaction exists. जब तक वो exist है तभी तक हम उसे compare करना है. Preference for international cup. Preferences for international cup. While both internal and external cup method is accepted, companies often find it challenging to identify external transactions sufficiently comparable to their own making the internal route more practical. So these were the key points we have to look after. Is there any question till now? It is with the costing purpose. We are looking into the costing method, not into the taxation. We are covering the costing. Okay. Next, we go with the benefit and risk of the cup transfer pricing method. When you have a right fact and data to apply cup method, it is almost foolproof. Your transfer pricing risk is very low. Okay, you are not going to be questioned with any authority. But that's because it's most exact way of determine the different transfer pricing. Most tax authority trust using this method when possible. But that said, a perfect cup is somewhat in of a unicorn. Why it is unicorn? It is very rare and may not exist. Downfall of cup method is that the standard of comparability is extremely high, where you wanted to compare the volume, where you wanted to compare the amount, where you wanted to compare the related, unrelated party, where you wanted to know what is the unit of measure you are taking, how many units you are selling. That is quantity also there, quality also there, like kind also there. So this is very high standards which we are putting into the cup. Transfer pricing regulations specify that a number of different factors such as volume, contractual terms, profit potential, to name few. These are the small things I'm saying must be comparable in order to apply this method. In order, other words, circumstances of transaction must be nearly identical. Satisfying these requirements is very difficult, very difficult, as there are many variables that can change end result. Okay, for example, say diamond company is selling 10 diamonds to in a order. Only comparable transaction impact the goods. Only comparable transaction can find are the 1000 diamonds. Okay, the cost per diamonds will be lower in the larger order. Obviously, na, in the 10 diamonds, I would have a selling overheads lesser than the 1000 diamonds. Definitely insurance, everything will be lesser in the 10. Okay, so many variable impact pricing on goods, intangible services, which is why it's hard to find sufficiently comparable transaction for applying cup method. Volume is just one example of how even similar transaction can have many inherent, okay, differences. As far as cup method goes, tax authority will likely to scrutinize even slightest differences are there. Okay, so this was the benefit as well as risk of the cup method. Transfer pricing example related to cup methods are first. Internal cup method, first example, a car rental company determining license fees for its Canadian subsidiary by referencing licensing agreement with an independent third party using their branding. So here transaction pricing internal cup method will come. Next example is a company selling industries equipment to both third party and related entities using the prices charged to the third party as reference to the related party transaction. Okay, external cup method. What is the external cup method? Example, a diamond company establishing a price to change its subsidiary for diamond by identifying comparable method between two unrelated companies in the market. So this is the external cup method where we can see. Okay, next is resale price method in transfer pricing. This is the second method. The resale price method is primary transfer pricing method, all of which are used to ensure that transactions between related companies are carried out at an arm length price. The resale price method is a traditional transaction method. This means its application look to transaction between unrelated party as a mean to determine an arm length price for the intercompany controlled transaction, where they actually say that buy from me on this price but sell it to this person at this price. Unlike some of the other method which can be used to analyze more than one type of intercompany transaction, the resale price method is always applied to tangible property transaction. We'll tell you a little bit about it, how it works. Let's go to another page. Examples, a US company that distribute running shoes buy shoe from a related company in Ireland. It also purchased similar shoe from another unrelated supplier. So related is in Ireland and another unrelated supplier is there. Assuming that the term and condition of the related and unrelated parties transaction are comparable, the resale price method can be applied to ensure the Irish company charge its related US distributor a price comparable to the price charged by the unrelated third party supplier. In resale price method stipulate that the gross margin earned by US distributor on the shoes purchased from the related company must be the same as the margin earned from the sales of shoes purchased from the unrelated supplier. If the distributor makes the gross profit of $65 on each pair of shoes from unrelated supplier and sold at $100, the gross profit margin is 65%. This is the gross margin which must be used to determine the price of the shoes the distributor purchased from the related Irish supplier. So here what happens, we do the calculation which is reverse, and what we do, we actually look after the profit percentage of the resale price. If you are going to earn the 65% of the profit, then and you are selling at the 100, then buy from me at 65 rupees. So this is how it works into the resale price transfer pricing. It is how it works into the resale price transfer pricing. Is there any question? Is there any question? Okay, let's move to the another slide. Cost plus method in transfer pricing. What exactly the cost plus method works by comparing the company's gross profit to the overall cost of sales. So what we do, we actually compare the profit percentage with the sales, and we see this will be the percentage at my cost which I'm going to take from my another division also. So what happens here, it starts by figuring out the cost incurred by the supplier in a controlled transaction between affiliated companies. For example, if there is a Amul company who is making profit of 10%. Okay, so if they are sending their milk to the butter department and they are not putting 10% of the profit as their gross profit percentage, they are not doing it right. So here what happens, we have to look after the cost plus method with the percentage of gross profit which we are making at the overall, not with the related, not with the unrelated party. It is more of a overall profitability of this. Okay, what happened then, a market based markup plus in the cost plus is added to total to account for the appropriate profit. So here what happens, the profit is always appropriate, at least not comparable, they are not comparable, not accurate, not reliable, but it is for the percentage of profit. This is for the percentage of profit. For many organizations, this method is a both easy and implemented, and it is and to understand very easily. But in many companies, it can be a reverse. It can be very reverse. In added, as we can see, in order to use cost plus method, a company must identify the markup cost for comparable transaction between unrelated organizations. Okay, this is very useful for assessing transfer price for routine. Where routine work is there, I wanted to make a transfer price by this only. There is a low risk activity such as manufacturing of tangible goods. For many organizations, this method is both easy to implement and to understand also. So what happens, if it is easy to understand, it will be easy to implement also. We will be able to see ki, this is my cost of production, make a profit over this. So downside of this method, and really all transaction method, because this downside is for the cup method also, resale value method also. This downside will applicable to everything. Okay, is availability of comparable data. How you can compare, how you will find the same contract, comparable contract, how you will find the same quantity, how you will find the same rate, how you will find the delivery same. There could be possibility na, one company is into the Punjab and one company is in Gujarat, so obviously my traveling cost will be different for both the companies. How can we decide the data from both the transaction, where we can actually say ki Punjab is a longer to go from Maharashtra rather than Gujarat. So we actually put sales and overheads lesser on Gujarat, and we have put more price on the Punjab values. So we can hear comparable data is very rare to find. We cannot get it on hand always, or at least not comparable enough to get accurate. So what happens, every time we got scrutinized, every time there is a audit for the purpose of transfer pricing, we need to go with this. If it is not apples to apple comparison, the result will be distorted. Obviously, apples to apples, then only it will be the good result. Otherwise, apples to orange, there is no comparison, and always we need to go with the transfer pricing, a different method. And even though we are using the best judgment method, we are using the best method, there is always a question mark over this. And another method must be used. Okay, examples of the cost plus transfer pricing. Do you have any question till now? The profit on the cost plus method is actually comparable as per the gross profit method. What I am making as a whole, then I can make a cost plus method, or maybe with the unrelated party, if I'm earning 20% of the profit, I can take that also. But there is always a question, there is always a somewhere criticism in every method we can use. We can go with the best method, but still there is some questions can be arise whenever we are using these methods. Sure, I will send it on this mail. Is there any question? So examples of cost plus transfer pricing method is a French corporate produced product under the contract for a German-based parent company and need to determine the appropriate markup, gross cost, okay, for the goods it sells to the German partner. If the French company made similar comparable transaction with the third party, the markup used those transaction can be applied to the sales to the company made to the related German company. If the French company has made no comparable third party transaction, then the transfer pricing team can identify several companies similar to the French manufacturer and apply those companies' average gross cost plus to the transaction with the related German company. So here again what happens, every method can be questioned at every stage. So transfer pricing is a very vast subject. It is more of a convincing power subject rather than the calculating. Your calculation need to be given with the evidence in this situation. Is there any question till now? So there is no question. So I would like to take a call over once. Okay, thank you for coming for this webinar. I hope it is some value addition to you as well as for me. And I'll see you tomorrow for the next generally aseptic accounting principle. Thank you for joining me. I conclude this. Thank you very much.